Okay, well, hello everybody. Welcome again to another edition of Accounting Principles. This is Professor Sam Lanzafame, and today we're going to talk about how to give customers a time extension on their accounts receivable. A lot of times customers have difficulty paying, and it's in the company's best interest to maybe work with these customers so that they don't have to write them off. So maybe they reduce their interest rate, or maybe they give them an extra amount of time to pay. And what they do in this situation is they convert the customer's accounts receivable into a notes receivable. The advantage to the company is that a note will stand up better in court than something that's on account. So there's a little bit more, oomph behind this particular receivable. But at the same time, it's important to try and collect that money from the customers as soon as possible, because there's an old adage, the longer a customer owes you money, the less likely you'll see it. So let's go ahead and start doing a quick little demonstration of this. So let's kind of go back in time a little bit, and let's see what the journal entry is when we just record a sale, or we perform a service. So when you're recording a sale, we know that let's assume it's on account. Let's write that too as well. So bottom line here is we want to debit accounts receivable. And typically we attach the customer's name. Let's just pretend it's John Doe. And let's pretend we sold John $5,000 worth of stuff. Okay, stuff meaning merchandise. So we're going to credit sales. If we were performing a service, we would credit service revenue, something along those lines. If we were under periodic, this entry is sufficient the way it is. If we were doing perpetual, I would then add a second journal entry to this recording of the sale, where I would debit cost of goods sold and credit merchandise inventory. I only do that if I'm under perpetual. If I'm under periodic, what you see here is sufficient. Since this chapter is not about periodic or perpetual, I'm just going to bypass this second entry and just move on to the main event. Okay, so keep in mind that right now John owes us $5,000. We've tried probably multiple times to try and collect this money, maybe phone calls for sure, email and regular mail, but we've had no luck. So let's say we were able to get a hold of John, and we discovered that John was having issues because maybe he filed bankruptcy, or maybe he lost his job. I mean, there are some customers where they just pass away, and that's why you don't hear from them. So we're trying to figure out, what's going on with John. He's alive and well, he just can't pay us, whatever the reason may be. So John agrees to converting his accounts receivable into a notes receivable. So this is the main concept of today's chat, and that is we're going to convert, well, let's put it this way, we are going to give the customer a time extension on his accounts receivable. And basically what you're doing is you're converting the accounts receivable into a notes receivable. So it's like closing the accounts receivable. How do you close something? You got to do the opposite of what you normally do. So notice that the accounts receivable is currently a debit. To get rid of it, we're going to have to credit it, and we're going to replace it with a notes receivable. Okay, so whatever amount was in the original accounts receivable, we are going to credit that and we are going to debit notes receivable in its place. Okay, let's assume the note, we would be also privy to some specifics associated with the note. Let's say this note was 8% for 2 years. Okay, 8% 2-year note. So at the end of 2 years, we're going to collect this $5,000 back plus any interest that's accrued since this point. Okay, so let's fast forward to 2 years later. The note matures, and there are two things that can happen. The note is either honored or dishonored. In other words, if the customer pays us, the note is honored. If the customer still doesn't give us the money, the note is dishonored. So I'm going to show you two different scenarios. We'll put the honored here, we'll put the dishonored over here, and we'll put the word or somewhere in the middle. Okay? So let's do one of these, and let's do one of these. Okay, so if the note is honored versus if the note is dishonored. So if the note is honored, that means we are going to collect the cash from this customer, which is what we are hoping for. The note receivable has to come off the books because it now has matured. So once the note has matured, it must be removed from the books. Whether we get the money or not, this has to happen. Okay? And we are also going to credit interest revenue because we have earned some interest. Okay? This entry is almost identical under dishonored with one minor modification. Instead of debiting cash, if the note is dishonored, we have to put the customer back into accounts receivable. Okay, that's the difference in the two journal entries. Notice the two credits are identical. Whether we get money or not, we still earned interest. Whether we get money or not, the note is history. The note had a 2-year life. At the end of those 2 years, it's got to be removed from the books. Now, a note can be in years, it could be in months, it could be in days. In this case, it's 2 years. So what we need to do now is we need to calculate interest. Let me do that up here. So we need to be able to calculate simple interest. And the formula for interest, you may remember this from some math classes or some previous courses, or maybe you read the chapter and you saw it in here. So interest equals your principal times your rate times your time. Principal times rate times time. This formula is very famous in this abbreviation, I equals PRT. Okay, so let's calculate the interests. So we're going to take the principal, which is $5,000, and we are going to multiply that $5,000. Hang on one second, get rid of this. We're going to take the 5,000 and we're going to multiply it by the interest rate that I gave you, which is 8%, and we're going to multiply it by the time. Since the interest rate is annual, we have to express the time annually as well. So we're going to do 5,000 times 8% times 2 representing 2 years. Had this been a 2-month note, I would have done 5,000 times 8% times 2/12. Since there are 12 months in a year, if it was a 2-month note, then I would go 2/12. But I only put the 12ths in there if I'm dealing with months. So 5,000 multiplied by 8% multiplied by 2, I come up with 800. So that's the amount of interest that this loan, in essence, has basically earned for us. So we want to make sure that we acknowledge that in our journal entry. So in both of these cases, we're going to have $800 as our interest revenue. The note receivable, that's the easy one out of the bunch. I don't need my calculator for that because the note has to come off the books the way it went on the books. So if it came on at 5,000, it has to go away at 5,000. Your debit is basically a plug figure. I need to do my 2 credits in order to figure out my debit. And we've seen that many times in other transactions. And remember, your debits have to always equal your credits. So 5,800, 5,000 plus the 800, and that's 5,800. And that's how you would handle, honoring versus dishonoring. Okay. Now notice we put in that, if you focus on the dishonoring for a second, notice we put that customer back into accounts receivable. So now the customer officially owes us 5,800. Now it's possible that we could give this customer a new note, and the new note's principal would now be 5,800. It's also possible that we could give up right now on this customer and say, you know what, the heck with it. This customer is not going to pay us anymore, so let's write them off. So at the end of the last video session that I had with you, I showed you this entry. I'm going to do it again. So what if we decide to write off the customer? And the way you write a customer off, assuming we're under the allowance method, you're going to debit your bad debt expense. I'm sorry, I misspoke. We're going to debit your allowance for doubtful accounts. Remember the AFDA that I introduced to you last time? So we're going to debit AFDA, and we're going to debit it for 5,800, and we are going to credit accounts receivable. So in other words, we're taking the customer off, not the way we prefer. We prefer to do this entry with a debit to cash, but unfortunately, we've decided to write this customer off. So that's the journal entry to write off a customer. Sometimes, however, and this is kind of weird, but sometimes the customer is not aware that we wrote them off, or doesn't remember, or never, looked at the mail. Who knows? But sometimes the customer might win the lottery somewhere down the road and pay you back, thinking they still owe you this. So here's the transaction for when you write a customer back on the books. So let's write customer back on the books. So first thing we're going to do is we're going to reverse the write-off as if it never happened. So you're going to debit the accounts receivable, John Doe, for the 5,800, and you're going to credit the AFDA. I'll use the abbreviation this time. So by doing this entry, we completely reverse the write-off as if it never happened. So when that happens now, you have to do a second entry, and we're going to debit cash. Remember, the whole reason why we're doing this, these 2 entries, is because the customer unexpectedly paid us. So we're going to debit cash for the 5,800, and we're going to get rid of the accounts receivable the way you always hope to get rid of accounts receivable, because the customer has paid you money. And that's it for this session. So I hope that made sense to you guys. Please read your chapter on this material. Usually most textbooks, the title is called Accounting for Receivables, or it might be called Bad Debts, but hopefully you'll be able to look this stuff up if what I just did doesn't make any sense. All right, the next video I will do is on credit card transactions, and that probably will be shorter than this one. All right, you guys, thank you again for being here. I hope these videos are helping you. Take it easy. Bye-bye.